Wow. That's how Fed's Mary Daly characterized the U.S. jobs report from Friday. The long-awaited easing of the jobs report once again never materialized. The announced job cuts from major industries has just not been equaled in the other industries in the economy. Let's review. 517,000 for non-farm payroll versus 185,000 estimate. 71,000 for the 2-month revision in November and December, making that jobs gain even stronger. 3.4% unemployment rate. It hasn't been that low since 1969. 34.7 hours for the average work week. That's up from 34.3 just last month. 0.3% for average hourly earnings. 128,000 for leisure and hospitality jobs. People are doing stuff out there and jobs are getting filled at hospitality establishments. Accommodations and food services was up 113,000 of that total. 82,000 for professional and business services. Those are high-paying jobs. 79,000 for healthcare and social assistance. 30,000 for retail jobs. 25,000 for construction. 19,000 for manufacturing, increasing the goods jobs nicely for the month. Information and financial services was sluggish, but overall, wow. So what are the implications? We will hear from Fed officials this week, including Fed Chair on Tuesday at 10 a.m. and Fed's Williams on Wednesday. I'm sure there will be others scattered in, but if data dependent, that piece of data from Friday overall is not helping the inflation fear argument. With more people working and with supply shocks more in the rearview mirror, the threat of inflation is still a threat because of the jobs. The supply shock, goods inflation cooled down, but the service inflation still remains a major threat for the Fed. Now, the Fed may close their eyes as they hit the storyline peak of 5 to 5.25%. and use the Bank of Canada's term conditional pause in rate hikes, but they hold the ball as far as how high they can go. They can still say the threat is too great, and with 3.4% unemployment, they have the room to be even more restrictive. Conditional pause may be further away than we think. The market, meanwhile, can counterize that hawkishness as they have been doing since yields peaked in October and November. The 10-year yield moved higher last week, but only by 2 basis points or so at the end at 3.526%, and is off the high of 4.335% from October 21 week. However, the 10-year yield did fail on the attempt to move below the 200-day moving average. The 2-year yield was up 8 basis points on the week, but at 4.29% is still well off the November 4 peak of 4.88%. Technically, it has the 100-day moving average above at 4.324% that, if broken, would tilt the threat more to the upside in that period. Stocks came off the boil on Friday, but the Nasdaq was still up for the 5th week in a row. Its low on Friday remained above the gap from Thursday at 11904.02. Watch that gap level for early bias clues. Move below, and the rotation back toward a retest of the 200-day moving average at 11465.53 cannot be ruled out. For the S&P, watch the 4100 level, which was home to swing highs from December. The S&P closed at 41,036.49 on Friday. For the U.S. dollar, the dollar index erased new dollar lows going all the way back to April of 2022 and ended up closing higher on the week. The price of the DXY is back above the 50% of the move from the 2021 low at 101.99. Let's call it 102. Is the low in place for the U.S. dollar? Risk is a move back above the 102 level for dollar buyers now. So wow is right for jobs, and implications may start to reverberate through other markets this week. Let's next take a look at some of the technicals that are driving some of your favorite currency pairs. All right, so to start off the technical analysis, let's take a look at the euro versus U.S. dollar. And if I take a look at this off the hourly chart, I've been telling a similar story for quite some time here. It's a story of the red boxes, and the red boxes show that the price stayed within ranges right through here. We had one little failed break up here, but most of the time the price was moving up and down, up and down, up and down, with this lower swing area down here as support and this higher swing area up here as resistance. And then we moved to the top side. We formed another swing area with lots of ups and downs through here. Admittedly, we went below it through here. One of the days last week, I guess last Monday, and the market then rebounded back to the upside. In between this red box is the 100 and 200 hour moving average. And as you can see, when the market moved above that moving average, we started to see increased momentum to the upside here in the euro versus US dollar until we reached a peak last week of 110.30 and then started its rotation back to the downside. It might have been helped by the bank decisions from the Bank of England and the ECB. Both of them raised rates by 50 basis, but the market didn't seem to trust what Chairman Lagarde said from the ECB, and the price started to move down, back to the 100 and 200 hour moving averages in trading Friday. Tried to move higher again, but then rotated back to the downside on a stronger jobs report. And as you can see, we moved back toward the low of this box right through here. What is interesting to note in trading on Friday was that this high price right here, where did it stall after the first initial move to the downside? Well, it stalled right near the high of, guess what, this swing area back through here. So there is some symmetry being developed and some respect, I guess, to the red box that occurred right through here by holding that level and rotating to the downside here in the euro versus US dollar. So what next? As we head into the new trading week, we're going to be watching down toward the bottom end of this red box, right through this old red box. Do better than that. I can draw a box instead of a squiggly line, but this is the red box that we're going to be paying attention to. We're going to be watching down to this area down through here to see if the market can break below this level right through here. If it does get below that level, not only will it get outside of this area, but we'll also move below the 50% midpoint of the move up from this low to this high. That would be a shift to the other side, if you will, of what has been the range since the beginning of the year for this currency pair. Get below the 50% at 107.558 opens the door for further selling pressure in the euro versus US dollar. Alternatively, could find some support, and what we're going to be looking for ultimately, if the buyers are going to take more control, is I wanted to get above this swing area right through here, which includes this low, but also getting above the 38.2, and then the high of this area right through here, this old swing box right here, the high of the swing box, and also near the highs from the corrective high that we saw after the initial move to the downside on Friday. So that's the story of the euro versus US dollar heading into this week. As you can see, we're heading more toward the lower end of this the target here. Get below the 107.55 level opens the door for further downside selling. Let's take a look at the dollar versus yen, and on the daily chart, this tells more of the story for this currency pair as we head into the new trading week. And what I want you to focus on here is this swing area right through here, where we had a number of different swing highs, and then we tried to use that level as support. Admittedly, the market moved below that swing area, but reestablished support in that swing zone right through here, and then before moving to the upside. By the way, the low right through here stalled right against the 100-day moving average. That was a key reason for the support buyers, and a reason perhaps why the market then reestablished support in this swing area before moving to the upside. Now, admittedly, in the month of December and in January, the price traded above and below this swing area, but note here that we did start to reestablish some levels of respect, I guess, for this swing area through here, where the market not only found support right through here, but when it fell below, it found resistance against it until really today's trading, early trading, we are seeing a break back above the high of that area at 132.02. That was a level that we need to get to and through in order to tilt the bias a little bit more to the upside in the dollar versus yen, and we are trying to do that in early trading in the Asian session on Monday morning. The next level to get above would be the 38.2% retracement. That's of the range going all the way back to the low price in March of 2020. So it was a big move to get below that level, and moving back above it at 132.54 would be a step in the more bullish direction here for the euro, for the dollar versus yen. We will see if that can indeed take place. But on the downside, we'll be watching the 132.02 level down to 131.25 25 in early trading this week. As long as the price can remain above that level, the buyers remain more in control in the dollar versus yen. Let's take a look at the sterling versus US dollar. I'm going to take a look at the hourly chart in this currency pair. And the Bank of England also announced that they were going to raise rates by 50 basis points this week, but they gave sort of a indication that things would be on pause, one of those conditional type of tightenings here to see if inflation can indeed start to come back down in the UK as a result of lower growth that they're expecting a recession in 2023. So we'll see if all that comes to fruition. But the U.S. jobs report also sent the dollar higher and the sterling down even further on Friday's trade. Big move to the downside, and you can see we are rotating a little bit more to the downside in early trading here today, making new lows, going all the way back to this day right here, which is back on January 6th. We are approaching this swing area through here where we had a number of different swing lows and highs going back in time. If I go back through this area right through here, you can see the number of different times that the market stalled in this yellow area through here. That's where we're starting to move back toward. As you can see here, that level comes in at 120.10 down to 119.91, so just above and below the 120 level. Sounds like a nice round number that would either hold support for the sterling versus US dollar or lead to further downside momentum on a move to the downside. We have the 200-day moving average also coming into play at 119.53. The last time the price traded below that level was back here in January 6th to be exact. So that would be on the downside if we get below the 120 level here in the sterling versus US dollar. On the top side, we're going to be watching the broken 61.8% retracement at 120.72, and then look up toward these other swing areas through here, including the 50% retracement at 121.437 and 121.665. I would think that the price or the market would not want to see it move back above the 50% retracement in trading in the new trading week. So pay attention to that level on any sort of rebound to the upside. Look for sellers to probably come in within this area right through here, 121.11, 121.26, and rotate the market back to the downside if the sellers are to take more control and keep control on any sort of move to the upside. So be aware of that. Let's take a look at the dollar versus Swiss. Next, we're going to take a look at the daily chart. On the daily chart, we did see a rotation down below what it was a key support down through here. A number of different swing lows through here that stalled the fall in here, and then here. And in the trading last week, we actually broke below that level, only to find the failed break lead to a sharp move back to the upside on Thursday, and then the rotation further to the upside on Friday on the jobs data. Now there's another swing area through here that we are trying to get to and get above, or we got above on Friday and are staying above, and that's going to be our support level in early trading this week, coming around the 191 or 0.9194 to 0.9211 level. As long as the price could stay above that level, it's more bullish on the top side. We have this area right through here where the market's going to be focused on as a next target. That's 0.9353 down up to 0.9382. In Australia, what do we have? We have a interest rate decision coming up on Tuesday morning in that country. The expectations are for another hike by the Reserve Bank of Australia. We'll see how that plays out from the currency perspective. But what we saw on Friday was that the Aussie versus US dollar fell sharply down, and we fell into this swing area through here where we had a number of different swing levels going all the way back in time and probably before this time through here where the market traded either highs or lows in this area. We did have an instance where the price did fall below it right on this day right through here, but that was short-lived and the market quickly moved back above and reestablished support against that area. And in trading on Friday, what we do, we came down toward, or actually in today's trading, early trading, the market came down into that area and we found some support buyers near the 0.6888 level. Again, we have the Reserve Bank of Australia interest rate decision that could be an impact on that currency pair as the market focuses from the dollar into the Aussie dollar, and that may be helping to give the pair a boost in addition to the support against the technical levels through here. On the top side, we're going to be watching the 69.39 level, 0.6939 level as level to get to and through on the top side. If this pair is going to continue its rotation in the upward direction after bottoming out here near this swing area. So buyers took a shot in early trading here today. We'll see if they can keep that momentum going to the upside, get above the 50% retracement of 0.6939 would be one of the signals that the buyers are taking back a little bit more control from the sellers in this currency pair. Finally, let's take a look at the dollar versus Canada to wrap up this weekend, this report. And if I take a look at the hourly chart of the dollar versus Canada, what we saw in trading on Friday was a move back above the 100 and 200 hour moving averages and rotation back up to toward the 61.8% retracement of this last leg to the downside. Admittedly, this pair has seen a lot of ups and downs over the course of the last month or so, if not more, of trading, and that makes it a little bit more tricky from a technical perspective. But what I like about this chart is this swing area through here. This has a number of different swing highs through here, where and also swing lows, as you can see on the break to the upside. And then in trading right through here, after the market fell to the downside, we did find early sellers against that level. Admittedly, the price moved above it and failed through here, but we are moving back up toward that area and trading on Friday. If we're able to get above that area, that would be more bullish here for the dollar versus Canada. The 50% at 133.90 would be a close support for that currency pair. On the downside, we have this other swing area through here in the 100 and 200 hour moving average. That you wouldn't want to see the price move back below now that the price has extended to the upside for the dollar versus Canada. So there you have it, a look at some of the major currency pairs from a technical perspective. Lots of ups and downs, admittedly, lots of levels to be that are in play, and there's no guarantee here. But what we did see on Friday was the dollar move off of low levels, and that may have turned the tide here for the U.S. dollars on the back of the stronger than expected jobs report and expectations that maybe inflation is not dead just yet. Good fortune with trading. My name is Greg Michalowski. Bye-bye now.